Hello. Hello, everyone. Good morning, or good afternoon, or good evening, depending on where in the world you're catching me from. It's great to see so many of you here today. It's amazing. We've got people from all around the world. We've got people from Florida, from Melbourne, from Texas, from Phnom from Montreal, from Utah, from Tokyo, from Penang, from Singapore, from Ohio, from Arizona, from Philippines, from Italy, from Jakarta, and too many to mention. Really wonderful to see all of you, and welcome to the ninth Black Market event. That's right, this is the ninth year we're doing Black Market, and as you guys know, this is the biggest event for us every single year. And it's where you get the biggest sales. And I know many of you have been waiting for this end of the year Black Market sale to grab our investing or trading courses or playbooks at the biggest discounts for the year. So go ahead and grab it, take advantage of it, right? At the same time, welcome to my webinar, which is the first webinar in this entire series. I'll be doing about four webinars in total, right? So for my first webinar, I'm really excited to share with you a lot of exciting stuff that I've prepared. And I'm going to really focus on helping you to build generational wealth for yourself by investing intelligently and investing safely in this AI revolution that we are in. Well, we call it the fourth industrial revolution, right? And also going to talk about the recent happenings in the market. Recently, the market has been declining a bit. So is that something to be concerned about? Is that the bubble bursting? Or is this actually an opportunity for those of you who miss the first part of this rally? Is it a chance for you to get in at a better price? Okay, so be looking at all these things today, a lot to cover. And if you can hear me and you can see my slides, let me know, right? Just type a yes so I know that you guys are there. You guys can hear me. Okay, wonderful, fantastic. All of you can hear me. So I believe that some of you are here because you want to create another source of income for yourself, trading the financial markets, whether from home or anywhere in the world. And some of you are here because you've got savings and you want to grow your savings at a much better return so that you can build your wealth a lot faster and be financially free, financially secure in the near future before all the robots take your jobs. Right? No, I'm just kidding, right? And so today I'm going to share with you exactly what it takes and what you need to do to achieve consistent profits as an investor in a stress-free, low-risk way. As you guys know, to me, the most important thing is to invest in a stress-free way, in a low-risk way. I mean, why be stressed up, right? And even more importantly, how do you invest in a way that's sustainable over the long run? Because we don't want to be like some people that make huge returns in the short term and then lose everything. We're not interested in that. We want to build generational wealth, correct? I'm also going to show you the exact methods that I use every day. And I show my students every day on how I manage my own investments, my own portfolio, which this year has crossed the $20 million mark. In fact, it hit about over 23 million in October. Then we had a recent drop. So now it's like about close to 21 million. But it's okay, right? Your portfolio can't go up in a straight line. You go through ups and downs, but over time, it will always go higher if you do the right thing. Yeah? So a lot to learn today. Take lots of notes. If you have questions, you can ask your questions in the Q&A tab, and I'll do my best to answer as many as I can at the end of the webinar. So stick all the way to the end for the Q&A session. All right, guys? Fantastic. Now, this AI revolution is not something new. As you guys know, I first talked about it 3 years ago during my 6 wave webinar. How many of you were there during this webinar called the 6 wave? This was, almost 3 years ago. I'm sure a lot of you were there. Some of you are new, you were not there. And if you're not there, let me do a quick recap on what I talked about 3 years ago, and let's see what happened since then. Okay. So if you take a look at the global economy and global markets, they are divided into what we call innovation waves. And these innovation waves, they last anywhere from 20 to 30 years on average. Okay. So what happens during this innovation wave? What happens is that a series of innovations transforms businesses, transforms the economy, and changes our life and creates a lot of new wealth. Yeah. So, for example, the last innovation wave was known as the fifth wave. So, the fifth wave over here, oops, give me a second. The fifth wave, this was from 1990 to 2020, that lasted for 30 years. So, what happened during the fifth wave? What was invented? You had the invention of software. Software was invented starting with MS-DOS, right? And then Windows, and then iOS, and then the invention of the internet. Remember that? And then now internet on your phone, the mobile internet, the invention of social media like Friendster, MySpace, and then we had Facebook, and now Instagram and WhatsApp, and the invention of cloud computing. All right. Now, how many of you honestly say that software has changed your life? Has software changed our life, both the way we work and the way we play? Of course, right? Has social media changed your life? For better or for worse, right? Has internet on your phone changed your life? Has cloud computing changed your life? Yes. We can't imagine living without all these things now. And all these inventions, they transformed businesses like Apple. They created new businesses like Microsoft, like Netflix, like Booking.com, which has Agoda, like Meta, like Google. All right. And it has created tremendous wealth. So during these 30 years, what happened? The S&P 500 gained 1,950% in 30 years. Now, this is despite two major crashes. We had the dot-com crash here and the great financial crisis, right? No, so despite two major crises, if you just hold through the ups and downs, in the fifth wave, you would have made 1,950%. That is about a 10% compounded return a year. All right. Now that's if you just buy the whole S&P 500. If you knew how to pick the highest quality companies that make consistent profits, which I'm going to show you how to pick today, you'd have made double or triple that return. All right. So for myself, I made my first million, my first 5 million. In fact, I made my first 10 million during the fifth wave. So I built my first fortune there. I'm sure many of you did that as well. Okay. But how many of you missed the fifth wave? Either you were too young to invest or you did not know how to invest. Any of you missed the fifth wave? So if you missed the fifth wave, what's the good news? The good news is that we are now in the sixth wave that started about 5 years ago. We're in the fifth year of this sixth wave, right? And like I said, 3 years ago, this sixth wave will be the most revolutionary of all the innovation waves of the past. It would have the biggest impact on economic growth, on corporate earnings, and on stock market returns. So I'm here to tell you that the stock market returns of the next 5, 10, 15 years is going to be a lot more than the last 20, 30, 40 years. Okay, why? Because this sixth wave is the AI and robotics revolution. Okay, and if you recall 3 years ago, I said, what are the companies that are leading this revolution? 3 years ago, I mentioned these companies. I mentioned NVIDIA 3 years ago. Nothing new, right? I mentioned Palantir. In fact, I made a whole video on YouTube about Palantir, right? I mentioned Microsoft and Google and Amazon and Meta. And these companies have led this AI revolution so far. Sundar Pichai, the CEO of Alphabet, what did he say? He said that AI will have a more profound impact on our lives than fire, electricity, and the internet. Okay. Now, all of us saw how the internet changed our life. Okay. And if you think about it, right, today, every company in a way is an internet company, right? So although like my business is education, but we are built online, right? And no company can exist today without being online. Would you agree? Would you guys agree with that? No company can exist today without having an online presence, right? So, in other words, today, every business has to be an internet business or be extinct already, okay? Now, at the same time, today, every company is an electricity company. All right. Now, can you imagine a world without electricity? Now, we can't because when we were born, we already had electricity. Now, not too long ago, before the 1930s, electricity was not common in homes or in companies. Did you know that? So only in the 1930s then more homes and more companies had electricity, and that transformed people's lives. That from there you could have shops open at night, you could have manufacturing on the assembly line. That gave rise to products like the oven, the the hair dryer, right? The television, and the oven. So electricity changed our life. Now, why am I saying all this to you? Because if you think that electricity changed our life, if you think that internet changed our life, holy shit. It is nothing compared to the way AI and robotics will change all our lives. All right. So nowadays people talk about, hey, is this an AI company? Is this not an AI company? Let me tell you that in the near future, every company will have to be an AI company or no longer exist. How many of you agree with that? Every company will have to be AI enabled or no longer exist. Yeah. I can tell you that my company recently, we've been sending a lot of our staff to all be trained in AI. They have to all be trained in AI. And nowadays, if you graduate from university and you're not proficient with AI, there's no way you can get a decent job nowadays, right? So the old saying goes, AI may not take your job, but someone who knows AI will take your job very soon. Okay, so same thing. If you're in business, a business that deploys and leverages on AI will wipe you away from existence. So we are in this revolution. We can either be destroyed by it or we can capitalize on it to build our next generation of wealth. And I'm going to show you today how you can be that second group of people. You build your generational wealth on this AI revolution. All right. So since I presented this idea 3 years ago, what has happened? Let's take a look at what has happened, right? Now, the AI revolution officially started on 30th November 2022. Why? That was when ChatGPT was first released and people said, wow, my God, this is amazing. This, I can talk to this computer, it can generate poems, it can generate anything for me, right? That was the ChatGPT moment. So since then, as you can see, the S&P 500 since then, which is about 3 years ago, yeah, almost 3 years ago, it's up 65%. Yeah. Now, was it a straight line? Does the market go up in a straight line? Yes or no? Nothing goes up in a straight line, right? It goes through what we call ups and downs, right? So wave up, wave down, 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 wave up. And recently, the last 1 week, wave down. Now, the market recently is only down like 5%, and people are freaking out. Oh, God, we're gonna die some bubble. Hello, it's only a 5% drop. And my guess is we're somewhere near the bottom here, right? But in April this year, we went through a 21% drop. Okay. Last year, sorry, not 2023, we went through an 11% drop. So there will be ups and downs, but this entire wave, this entire revolution is very much intact. And I'll show you all the evidence in a short while. Okay. So the S&P up 65% in the last 3 years, big deal. Okay. Companies that are at the forefront of the AI revolution, that are involved in semiconductors, in AI software, they are up a lot more, as you guys know. Okay. So for example, one of the biggest winners, which I bought at $9, you guys have been following me, you know, a Palantir up 2,000% in the last, give me a second, let me just change my color here. Yeah, Palantir up 2,000%, NVIDIA up 991%, Broadcom up 500%, Meta 396%, Google up 200%, Tesla up 163%. As you guys know, this is the only one that I don't own. I own the rest of them, right? Microsoft up 100% versus the S&P up 65%. Now, how about my portfolio? Okay, so today I'm going to be very transparent. I always am. I show you my portfolio. Now, my portfolio, do I only have AI stocks, by the way? Do I only have AI tech stocks? No. You guys who are in my community, you see my portfolio every month, you know. What percentage of my stocks are AI related? Probably about less than, yeah, about 30%. 30% are AI related. The rest of my companies are all great companies, but not directly AI related because I believe you need to diversify to have a bulletproof portfolio that will do well in any economic situation, right? So my portfolio is up 109%, as you can see, over the last 3 years since the start of the AI revolution. And this is way outperforming the S&P 500. Okay. Now, for those of you who have learned how to invest through our investment courses, and those of you who have been investing together with me in the Ultimate Investors Playbook UIP community, where you get to see what I'm buying and selling every day, you guys have been doing very well. You know, you can see all the testimonials that we get almost every week. People like Chun Wee said, my investing journey was consistently losses over a decade, struggling to find a winning strategy until I discovered the value momentum investment course, which is the whale investor course, which completely changed my investment mindset and philosophy. In 2023, he was up 84%. In 2024, he's up 103%, right? And people like Juper, who is from Texas, originally from Philippines. He went to Texas, he's working in Texas right now, and he's on YouTube with me in an interview. Go watch that video. He said, Adam, I'm truly blessed to have you as a mentor for investing in life. Thank you a million times over. He did 242% in the last 3 years. Okay. And then people like Andrew said, here's my returns for 2024, up 83%. With my portfolio performance this year, I finally completed a full circle in getting back all my losses suffered in the stock market after 12 years. It is indeed a milestone for me. All right. And then, of course, the list goes on. So many people over here. I'd like to thank you and your team for making my investment journey profitable. Before I joined you as a student, I lost 80% of my retirement since it was invested in stock from the company I left. I'm happy to report that since I've been with you, I'm up 50% from where I started with 2 consecutive years, up 40% and 10x in Palantir. Thank you for helping save my retirement. So, you know, the decisions you make on finance will have huge implications on your life in the next 10, 20, 30 years. That's why it's so important to learn this stuff right now. So, $1 million question. Yes, we've made a lot of money the last 3 years. I made, you made, we all make together. But is the party over? Is it the end of the ride? Are we at the end of this AI build out? Is this a bubble that is bursting? Or are we still at the early stages of this AI revolution? I think this is the $1 million question a lot of people are asking, and that's why you're here today. Yes? Okay. Now, I don't mean to be rude. No, sometimes I wonder whether I'm rude sometimes, right? But let me put it in very diplomatically. Should I say diplomatically, right? If you think that we are at the end of this AI build out, that we are at this bubble, you have no freaking clue. I told myself I'm not going to be vulgar today, all right? But you have no freaking idea the tsunami, the tectonic, the transformative impact AI is going to have in the world. You have got no freaking clue, right? Okay. So today hopefully I'm gonna share with you ideas to give you a freaking clue. For those of you who have not been reading, who have not been catching up, let me give you that freaking clue right now. Okay. Now, the first thing to understand is that AI is in what we call a super cycle. It is not a fad. It is not a cycle. It is a super cycle. Now, what is a super cycle? A super cycle is defined by ChatGPT, okay? It's an extended period of strong, sustained growth lasting at least 10 to 40 years, okay? A super cycle lasts 10 to 40 years. And right now, How many years are we in the AI cycle that started in November 2022? How many years are we in? How many years are we in? We're only in year three. Year three, okay? This thing's gonna last at least 10 to 40 years. Now, let me show you this. So, how did this whole thing start? So, this thing started again in November 2022 with the launch of ChatGPT, right? And so, it started with what we call text to text large language model. So, you ask a question, it answers you. You ask another question, it answers you, right? Text to text. And then some of you know that now with you create text, you create images. How many of you have been playing with AI where you ask it to create a picture and edit a picture? How many of you have been playing with that? All right. So it started with Mid-Journey, and now there's thousands of software, right? And then we have got video, where I say, create this video for me. How many of you have been playing with that, right? You can now make videos and stuff like that. And so we had Sora, we had Veo, and now which is the most powerful video and image software? Which is the most powerful one right now? Everyone's talking about it. It is Nano Banana Pro. It is freaking amazing. You got to learn Nano Banana Pro. It is owned by Google, right? It's by Gemini. It is amazing, right? So we started with generative AI. So again, we have been doing this for only 3 years. And where are we now? We are now right here. Okay. And by the way, this is continuing to improve every single day. What is the next stage that we just started? From generative AI, what is the next stage that we are now only beginning to build? It is agentic AI, or what we call AI agents, right? Now, what are AI agents? They are digital agents capable of enhanced reasoning and decision making with minimum human oversight. So the large language models is like you ask a question, it answers you. You type something, it creates an image, right? Digital agents are like digital employees that work autonomously, and they can do many things autonomously, right? So for example, my company, recently we spent a lot of money. We sent all our staff to learn about agentic AI so that my staff in my company can now build AI agents themselves. So with AI agents, you can use the agent to do cold calling for you. We built an AI person that you can't tell is not a human being. It sounds exactly like a human, but it's AI that makes cold calls for us, for customers. We build AI agents to help us to book flights, to book hotels, to read emails, and to reply all our emails, all done by AI agents. And now my entire company is being trained in agentic AI. Okay. So the AI agent market is forecast to reach 42.7 billion in 2030. So how do you build AI agents? You have got many platforms. You have got Agent Kit by OpenAI. You got the Microsoft Agent Framework by Microsoft. And Google just launched the most powerful AI agent platform. How do you know what it's called? What is the most powerful AI agent platform? Just launched a few days ago. It's called Google Anti-Gravity. That's right. Go check it out. It's called Google Anti-Gravity. So with Google Anti-Gravity, you can create all these AI agents, right? Now, for those of you who find it hard to imagine what it is, okay? How many of you watch Iron Man? Iron Man, the movie? In Iron Man, Tony Stark, he had this Jarvis, which was an AI agent, which was this person that he talks to that can do everything for him. That is an AI agent. So in the near future, all of us will have an AI agent, right? Right now, you've got to start learning to build AI agents. It's really powerful stuff, okay? Now, this will probably take anywhere from 3 years to 6 years to build out, all right? So another 3 to 6 years on that. Then what's after AI agents? What's the next leap? What's the next leap? The next leap will be physical AI. Basically, robots built with AI systems. And is this already happening, by the way? Is this already happening? Yeah. So the first place you're seeing it is in robo taxis. Okay. The robo taxi market is growing at a CAGR. CAGR means compounded annual growth of 91.8% for the next 5 years. 90% growth for the next 5 years for the robo taxi market. It's going to be worth $45.7 billion. Okay. Now that's already happening. So many of these things are happening concurrently. So right now, the robo taxi market is also starting now. Okay. Now, robotics. How many of you have been watching a lot of videos on all these robots already? It's pretty cool. Who has been watching all these robotics videos on social media? Cool and scary, right? So humanoid robots will be a 5 trillion market. 5 trillion in the next 5 to 10 years. Apple's next biggest business is building humanoid robots. Apple is now building robots that will work and live in our houses, in offices, in companies, right? Xpeng from China says the robotics industry will be bigger than the automotive sector. Now, let me ask you this question. In order to build all these AI agents and robots and robot taxis, do you need a tremendous amount of computing power? Yes or no? Yes. And the computing power we are now using is less than 5% of what is required for this entire build out that's going to take the next 10, 20, 30 years. We are just at the what? We're just at the what? Sorry, we're just at the what? We're just at the early stages. Now, how many of you are old enough to remember the early stages of the internet? How many of you are old enough to remember this sound? Let me play this sound for you guys. And let's see how many of you are as old as me. Hold on, let me see if I can play this sound. How many of you are old enough to remember that in the old days, to get online, it took quite a long time? Good. Now, how do I turn this off? Holy crap. Okay. Remember that, guys? Okay. Yeah. So right now, in the AI revolution, we are at that dial-up stage right now. We are just at this dial-up stage. Okay. We're just at this dial-up stage right now. Let's talk about robo taxis so you understand the extent of that. Okay. By the way, which company is now leading in robo taxis? Which company is leading in robo taxis? Waymo, which is owned by Google, right? So Waymo, so if you go to San Francisco, you can see that a lot of the Uber rides on San Francisco, they are driverless. They are all by autonomous robo taxis. And now Waymo is expanding to Miami, as well as Houston, Dallas, San Antonio, and Orlando, and very soon all across the US. Singapore, have you just read? Next year, Grab is planning their robo taxi rollout very soon next year. So you can imagine that in the next few years in Singapore, there'll be more robo taxis than human drivers in the next couple of years. It's going to be very, very fast. Yeah. China, by the way, China, do they have robo taxis? Well, right now it's mainly in Wuhan, but now they're expanding to the 4 top tier cities to have 300,000 robo taxis. Okay. So Singapore is going to start next year. And yeah, there'll be no more Grab drivers in Singapore very soon. In the old days, they say, no job, drive Grab. Now cannot. Now all robo taxis. Okay. This is happening. Robots, let's look at robots, right? Have you been watching on social media, robots that are running marathons with human beings? Robots that are in fighting competitions? Robots that are in kitchens cooking now? And this is a factory robot by Amazon. Okay. Now, currently, Amazon uses 1 million robots, 1 million robots in its factories. And it is looking to replace another 500,000 factory workers with humanoid robots, so that eventually 75% of the entire Amazon operations will be run by robots. Okay. Now, as an investor in Amazon, is this good news? as an investor in Amazon is good news. Why? By the way, Amazon's e-commerce business is the least profitable of its businesses. Their e-commerce business, their profit margin is only 3 to 4%. Okay? Once they fully deploy robots in all their factories, in their logistics, their profit margin can easily double or triple. Double or triple. Now, if you calculate the bottom line impact, their share price can easily double or triple just on this. Right? That's why my biggest position in my portfolio is Amazon. Although the share price hasn't gone up as much as Palantir or Nvidia or Google recently, but my bet is in the next 3 to 5 years, Amazon would overtake everyone. Okay, that's just my bet. All right. Okay. Now, so should you invest in robot makers, by the way? Should you invest in companies that make robots? The answer is I wouldn't. I would not invest in a company that just makes robots. Why? Because take a look. Look at how many companies are making human robots. How many? How many are there? There are hundreds and hundreds and hundreds. Sorry, not hundreds. In Suzhou alone, Suzhou, China, there are 2,000 companies that are making humanoid robots that are far advanced. They'll be far more advanced than the US robots that are much, much cheaper, right? So I will not invest in robot makers because it's going to be so competitive that in the end, all of them are going to make very little money. So instead of investing in companies that make robots, what do I want to invest in? What do I want to invest in? I want to invest in companies where all the robot companies have to use this product, which are robot foundational models. They have to train the robots, right? Okay. So which are the companies that provide the training models? Basically, Nvidia and Tesla, possibly, Alphabet, Meta. Okay. And more importantly, the GPUs. No matter what robot you use, you got to use Nvidia. That's why Nvidia is one of my biggest positions. So that no matter which robot company wins, Nvidia will win. Right? So don't invest in robot makers because they will all kill each other. Invest in the things that they must all use, which are foundational training models and high performance computing chips. Now, let me give you an example. All right. If you look at the airline industry, now, the airline industry, has it been a huge growth industry? Yes or no? Has the airline industry been a huge growth industry? Yes. Now, let me tell you something, right? In 1914 was the first commercial flight. In 1930, there were 400 airline companies. In 2008, there were 22. In 2020, there were 18. And since 1930, the industry in aggregate has lost 60 billion over 32 years since deregulation. There have been 86 bankruptcies in 40 years. So what does this mean? This means that today everyone takes a plane, right? The airline industry has been a huge growth industry, but if you add together all the profits of all the airlines in the world, the total profit was negative. They lost 60 billion in total. Why? Because there's too much competition. So as you guys know, one of my rules is in investing is what? I don't like to invest in companies that have a lot of competition because in the end, no one makes money, correct? I like to invest in companies where there's little or no competition. So if you take a look at the airline industry, none of the airlines made money in 40 years. None of them, okay? But which company made money from airlines? Basically, all the airlines had to buy planes from Airbus or Boeing, correct? Yeah. So you don't want to own airline companies. You want to own either Airbus or Boeing, right? But of course, Boeing recently has been doing very badly because of their plane crash, lah. But Airbus has been the main leader of it, right? And okay, now same thing with the auto industry. Now, as you guys know, I never ever invest in auto manufacturers. I never invest in airline companies. I will never invest in robotics companies because they are just too competitive. Okay, in the auto industry, in 1919, there were 2,000 car manufacturers. 2,000. Okay, by 2009, there were three left. That means 1,997 went bankrupt. Okay, only three left: General Motors, Chrysler, and Ford. GM went bankrupt twice, or is it one time? I can't remember, right? Chrysler and Ford hardly make any money. Okay, and in the current day, there's only two left, which is GM and Ford. And of course, Tesla started in 2008. And now Tesla, their car business is also not doing well because they are being there's tremendous competition from the China EV market, right? So one of the things that's why I say I never buy auto car companies, I never buy airlines, and I'll never buy robots. It's just too competitive. But I want to buy companies where all these companies have to use their products. Does this make sense, guys? Okay, so this is a bit of a detour here. So let me share with you some more information on why we are just at the beginning of this AI super cycle. Now, recently, have you been reading that, oh, the companies are spending billions and billions, they're spending too much money on AI infrastructure? Have you read that? Yes. Now, let's put it into perspective. If you compare the AI build up today, this is today's AI spending, compare it to past industrial revolutions. As a percentage of global GDP, we are just here. The US telecom build out, the US information and communications technology hardware build out, the US electric motor build out, the US auto infrastructure build out, the US railroads build out was much larger than where we are today as a percentage of GDP. So as a percentage of global GDP, the current AI spending is nowhere close to past infrastructure build-outs. Okay? This article just came out yesterday. Google, all right, they said they must double their AI compute every 6 months for the next 4 to 5 years. They must double their AI computing power, double every year for the next 5 years. Okay? So this is why we are just at the early innings, right? So generative AI is projected to become a $1.3 trillion market by 2032. That's in 7 years, growing at a CAGR, which is an annual return of 42% over the next 10 years. What are the largest drivers of this generative AI revenue? It'll be, number one, generative AI infrastructure as a service used for training large language models and inference. Okay, digital ads driven by AI, which is basically Meta, Netflix, and Alphabet. Okay, specialized generative AI assistant software, AI servers, AI storage, computer vision and AI products, which is basically Meta and Apple, and conversational AI devices. So if you look at this table here, this is where the biggest growth is in. So a lot of the companies that I'm going to invest in or I'm investing in is going to capitalize on the biggest growth opportunities in AI. Now, let me ask you this question. Is it only AI? Is it only companies that build AI systems that will do very well? Yes or no? No. It is any company in every industry that will leverage on AI. So let me show you this table over here. Now, so far, you can already see the impact, right? AI is significantly increasing productivity and increasing profit margins of companies in all industries. This was just out a few days ago. The current profit margin of the S&P 500 companies is 13.8% profit margin. Okay. Now, the profit margin was 4.9% 20 years ago. So in other words, profit margins of companies have tripled in 20 years because of the increase in productivity, because of the recent deployment in technology and AI. So what this is saying is that companies are making more money today than they are in the past. So that's why the stock market keeps going higher, because companies make more money. It's very simple. Okay. This one. Okay. Now, this is by McKinsey. Generative AI could add 2.6 to 4.4 trillion to the global economy. In what way? In all industries. So for example, generative AI could add 600 billion in new revenue for the consumer packaged goods industry, 340 billion in value for banks. So a good example is DBS. Now, DBS is one of my biggest positions in my dividend portfolio. I've got over $1 million invested in DBS Bank. Now, I didn't invest $1 million, I invested much less, but it now grew to over $1 million, right? How many of you are invested in DBS Bank? It is one of the best banks in the world, in my opinion, okay? And do you know that now DBS uses over 100 AI and machine learning algorithms in financial planning, wealth management, customer service, virtual assistance, and fraud detection? So in other words, DBS is an AI company. DBS is an AI company. That's why DBS has overtaken UOB OCBC significantly, because it has been deploying AI in over 100 parts of its company. All right. So AI will not just make semiconductor companies wealthier. It's every company in the world that is deploying AI. Now, how many of you have read this narrative that, oh, AI will take away people's jobs and people have no more jobs? If people have got no jobs, how do they spend money? If they don't spend money, the whole economy will collapse. Oh my God, we're going to die. How of you have been reading that narrative? Have you read that stupid narrative? Okay. Now, like I always say, don't trust what you read in the media, because the media always like to sensationalize bad news. There's always two sides to a story. Now, let me show you the facts of the other side, okay? Now, here are the facts. Do you know that population growth, okay, is growing much? Okay, sorry, let me repeat that. Do you know that the growth of the workforce in the world is much slower than the growth of the global population of the world? Okay, so take a look at this chart. From 2018 to 2028, okay, the world population is projected to grow 7.6 billion to 8.4 billion. That's a 700 million increase in the global population, okay? But the global workforce, that means people working, will only grow from 4.9 billion to 5.4 billion, which is 400,000 new workers. So the population is growing more than the workforce, okay? So in the world, there is a shortage of workers. There's a shortage. Can you see the shortage? By 0.9%. Now, this is in the entire world. If you look at high-income countries like the US, like Singapore, the change in population is 45 million, okay? The change in the workforce is minus 8 million. So there's a 4.9% shortage of workers in developed countries. Why? Why? Why is there almost a 5% shortage of skilled workers in developed countries because of the declining population. Singapore birth rate dropping, Japan birth rate dropping, US birth rate dropping, right? Not enough babies to become workers. And the people who are here are growing older and older. So did you know, look at this chart, there is a shortage of labor now, or rather there's going to be a projected shortage of labor from 2018 to 2054. It is the first shortfall since 1973. By the way, this research is by Fundstrat, so credit to Fundstrat for this research. So what does it mean? What does it mean that there's going to be a huge shortage of labor in the next 30 years? What does that mean for technology? What does that mean for AI? Does that mean will there be a bigger demand or less demand for AI and robots? You tell me. More demand, that's right. So let me show you this next chart, also by OpenAI. Okay, now, when was the last time there was a labor shortage? First, 1948 to 1967, labor shortage. 1991 to 1999, labor shortage. And now there is a labor shortage up to 2045. In the last two periods where there was a labor shortage, you can see that technology spending, companies spending on technology, and now AI, it increases significantly. Can you see that? So right now we are here. So with the labor shortage in the next 30 years, companies spending on technology and AI will be what? Will be exponential. This is where I'm investing. Okay? So far, is this useful information, everyone? Is this mind-blowing information? I mean, I read about this every day. I spend my time every day researching on this, and this to me is mind-blowing. Okay? Now, let's answer the next question. So now you say, okay, Adam, we are just at the beginning of the AI revolution, the AI build out. There's a lot more to go. But have stocks already run too far ahead? Does the stock market, is it already too expensive to buy in? So let's take a look again at the facts and ignore the media bullshit narrative, right? Now, some people would say that the stock market is expensive. Why? Because they look at certain metrics. They look at this thing called the price to earnings ratio. And if you look at the forward PE ratio of the S&P 500, it is now at 22.4 times. So is that high or low? Well, if you compare to the last 5 years, the average PE ratio, forward PE was 20 times, and the average in the last 10 years is 18.7 times. So purely from a PE ratio perspective, yes, the market is above the historical average, okay? But is it very high? I wouldn't say that. It is slightly above the average. Now, however, I've said many, many times, PE ratio by itself can be very meaningless, can be very, very, what's the word for it? Misleading. Why? Why is PE ratio very misleading? Because it doesn't take into account what? What doesn't it take into account? It doesn't take into account the growth of the earnings, right? So remember, PE ratio, it doesn't take into account the growth of the earnings. And are companies growing earnings faster today than 10, 20, 30 years ago? Yes. And like I said, companies' profit margins are triple today what they were 20 years ago. So you cannot compare today's PE ratio with the PE ratio 10, 20, 30 years ago. It doesn't make any sense. Okay? Now, remember this. If I have two companies, company A and company B, company A PE ratio is 5. Company B PE ratio is 30. Now, which is the more expensive company? Which stock is more expensive, A or B? Now, a lot of amateurs will say B, right? Wrong. Who says it's B? It depends on the earnings growth. What if I told you that company A, the earnings are growing at only 1% a year? But company B, the earnings are growing at 30% a year. Now, which company is cheaper? Now, company B is cheaper, right? Why? Because if you take the PE ratio, divide by the earnings growth, you get the PEG ratio, which is a more accurate way of measuring it. Okay, so 5 divided by 1 is 5. This one, 30 divided by 30 is 1. So company B, PEG ratio 1, cheaper than company A. That's why 3 years ago when I bought NVIDIA's PE ratio was 60. People say, Adam, it's so expensive. Are you crazy? I say, no, it is not expensive because NVIDIA is growing their profits at 30, 40, 50%. And since I bought NVIDIA, it's up over 1,000% in the share price. Why? Because NVIDIA is not expensive if you take into account the growth of their earnings. Later, I'm going to show you. By the way, have you guys heard of Palantir? Now, is Palantir expensive? It used to be very expensive, right? But recently, based on their last earnings report, if you take the latest valuation, Palantir is no longer very expensive because the earnings have grown into the share price. Same thing with NVIDIA. NVIDIA's earnings have grown into the share price. So you cannot just look at the share price and say, oh, the share price went up 1,000%, is expensive. Rubbish. If the share price goes up 1,000%, but the profit goes up 1,000%, then the stock is not more expensive. Okay? So we're going to look at all that in a short while. So hang on with me. Now, what's more important is to look at not P ratio, but what? The PEG ratio of the S&P 500. And if you look at the PEG ratio today, when I talk very passionately, I get very hot. Then I start sweating. So I need to full blast my aircon now. Hold on, give me a sec. Okay. The PEG ratio of the S&P 500 now is only about 1.3. Is that expensive? No, use your brain. Okay, I'm talking to people who say, oh, the market is expensive. No, it's not. Look at the PEG ratio. It was at 2. It was at 2.4. It was at 1.7, 1.5, 1.5, 1.5, 1.5. Right now, we are here. If you take into account the earnings growth of the companies today, we are not as expensive as where we were in the past 20 years. Right? Okay. Let me show you this chart. Now, people who say that now the market is like the dot-com bubble in the year 1999, 1998, 2000, they are freaking idiots. They are freaking, I'm just being very polite today, okay? They're freaking idiots. Now, I'm old enough to remember the dot-com bubble because I invested during the dot-com bubble. And I can tell you that today's market is completely different because during the dot-com bubble, the stock price went up every day, okay? Every day. Companies don't make money, companies have no revenue, the stock price also go up. Now, that was a bubble. Today, you got companies like NVIDIA, like Amazon, like Palantir, they show very good profits. The stock price drop. That's not a bubble. That's not a bubble, right? It's totally different. Now look at this chart. This was the dot-com bubble. Now, this line in brown is the share price. Okay, this is the share price. And this line in gray, that is the earnings of the company. Now you can see in the .com, the share price went up, but the profits were very low. And that caused what we call a bubble. And that's why it collapsed. Because eventually the share price will come back to the value of the company based on what it can earn. Understand? That's why I always say, as investors, you always have to calculate the intrinsic value based on the earnings and the cash flow of the company. If you look at today, the companies that are leading the AI revolution, yes, the share price has gone up a lot, as you can see, but the earnings have been supporting the share price. NVIDIA is reporting record earnings, Meta record earnings, Amazon record earnings, Apple record earnings. The earnings are there. This is not a bubble. If you think it's a bubble, you are very stupid. I don't mean to be rude, but you're really very stupid. Okay? Now, having said that, are there areas of the market that are in a bubble? Are there certain areas that are irrationally priced? Yes. Okay. And I showed this slide about 1 month ago. If you guys have been following me on YouTube, I showed this 1 month ago. I said, be careful of these stocks. Remember, I said these stocks are bubble. Why? Because many of these stocks, they don't have any profits. They don't have any profits. The share price going up is purely on hype, not on profits. Okay? So what? So are there some AI stocks that are bubble? Yes. Like CoreWeave, that's a freaking bubble. Okay? Like Nebius, that's a freaking bubble. Now, the good news is that this bubble has already started to burst since I talked about it 1 month ago. So since I talked about it, CoreWeave is down 60%. Nebius is already down 30%. Okay? Quantum computing stocks. This is also a bubble. This is also a hype, all right? This IonQ is down 40%. RGTI down 55%. Now, some people say, Adam, does it mean that now is a good buy? Is this now a good buy? Hello? Hello? What do you think? Down 40%, down 50%. Is it now a good buy? Well, in my opinion, I wouldn't dare to buy. Why? Because these companies don't make money. So even if it drops 90%, I still won't buy. I still won't buy because there's no commercially viable quantum computer yet. And they said one day we'll make this computer. This one day maybe 30 years from now. Okay? Next, cryptocurrency treasury stocks like MicroStrategy, or they call it Strategy, down 65%. Or BMNR that buys Ethereum, down 80%. Now, you guys know how I feel about cryptocurrency. To me, cryptocurrency is something you can speculate. You can trade it. You can make a lot of money in crypto using short-term price manipulation trading. That is what Alson will teach you later on, all right? But for investing, no. Because there's no profit, there's no cash flow, it is driven by the greater fools theory. So this can drop 90%, I still would not dare to buy it, okay? Nuclear energy stocks. Now, nuclear stocks, I think, have a lot of potential. They have a lot of potential. In fact, I like to invest in nuclear stocks, but I think they are still a bit expensive, right? So like Oklo down 45%, SML down 65%, okay? Uranium stocks. Now, LEU, Centrus Energy down 48%, Chemical down 25%. If you ask me, out of all these companies, I would say the only one that I think is still not bad is actually Comico. This one is still not bad. This one is still not bad. All right. Now, why? Why do I say not bad? Okay. Again, let me show you very quickly. If you look at Comico, let's look at some of the fundamentals, shall we? Okay, so let's look at Comico, right? CCJ. And like I said, this is not bad. Now, it doesn't mean that I'll invest in it. I still wouldn't dare to invest because to me, it's not safe enough, right? But at least if you look at Comico, you can see that, oh, it's still a bit expensive, sorry, right? The intrinsic value is $49. Now it's at 79. So it's still very expensive, right? Still very expensive. But at least it's making money. At least it's making money, okay? If you look at the financials here, okay, you can see that at least it is making money, right? It is profitable, and at least they have got positive cash flow, right? So this company at least is making money, but it's still very expensive. But if you look at the other company, which is the quantum computing, like IONQ, this one. First of all, there's no moat, and you can see that it doesn't make money, right? Look at that. Lose money, lose money, lose money, lose money, lose money, lose money, lose money. And the free cash flow is also negative. Okay. Now, always remember this, guys. When you buy a stock, what are you buying? When you buy a stock, what are you buying? You are buying a piece of a business, right? Okay. Now, what is a business? What is a business? A business is a money-making machine. The more money it makes, the more it is worth. Correct? The less money it makes, the less it is worth. Okay? If the business doesn't make any money, then what is it worth? If a business doesn't make any money, what is it worth? It is worth purely what people think it is worth, right? It's purely psychological, correct? And the trouble is that if something is priced based on psychology, based on perception, the trouble is once the perception changes, once people's sentiment changes, the share price can drop 90% or zero very fast. But if you buy companies that are actually making money, then you have no fear. Because even if the share price drops temporarily because of sentiment, you know that the company actually makes money, right? The price would eventually bounce back to the value of the cash flow. Okay? So that is something very, very important. So let's take a look at the components of the S&P 500. So when people say that, oh, the stock market is expensive, it's like saying all Americans are rich. It's like saying all Singaporeans are rich. Is that true? It's not true. Yes, there are some Americans, there are some Singaporeans, there are some Malaysians, there are some Australians that are very rich, right? But not all of them are rich. There are some that are not rich. Okay, so same thing. You have to look at the individual companies in the S&P 500 and to see which are expensive and which are cheap. Okay, so this was just published yesterday, so this is brand new. And you can see that out of the 500 companies in the S&P, you have got altogether, let me just add this together, 18.8 plus 16.6. So roughly about 35% of the stocks in the market are expensive. They are selling more than 20%, sorry, selling more than 10% above their intrinsic value. Now, 27% of stocks are fairly priced, which is plus minus 10% of their intrinsic value. And you can see that about 37% of stocks are undervalued. Okay, so what am I saying? What I'm saying is that in the market today, even though the market is just 5% below the all-time high, but there are many companies that are actually undervalued. that make very attractive investments. Okay, someone is asking me, they say, Adam, wasn't Palantir loss-making back in 2021? Correct. That's why I didn't buy Palantir when it was losing money. I only started buying Palantir in late 2022 when it turned free cash flow positive. When it had the first 2 quarters of positive free cash flow, then I bought Palantir. Before that, I didn't buy it. Okay? Now, specifically, which are the stocks? Well, let me give you an overview over here. Let's take a look at this. So what are the stocks that are very expensive now in the market? Apple, overvalued. Exxon, overvalued. IBM, overvalued. Robinhood, overvalued. Goldman Sachs, overvalued. CrowdStrike, overvalued. Costco, overvalued. Oops, sorry. Right? And you can see for yourself the rest of them, right? Then stocks that are overvalued, slightly overvalued, you have got Autodesk, you've got Bank of America, you've got DoorDash, right? You've got Google. Google was cheap for a long time when I was buying, and now it's really overpriced, right? Palantir is slightly overvalued. Slightly overvalued. And you can see the rest of them, right? Moody, slightly overvalued. Monster, okay? Now, fairly valued, you can see over here. Undervalued, very undervalued here. Now, so again, does it mean that as a good investor, I will just buy the companies that are undervalued or very undervalued? Would I buy all these things? Yes or no? Would I buy all these things? Yes or no? No. Why? Because cheap crap is still crap. Cheap crap, write this down, everyone. Cheap crap is still crap. One of the most common mistake investors make is they buy stocks simply because they are cheap. Never buy a stock just because it is cheap. The most important thing is what? What's the most important thing in investing in a company? Is the quality of the company. That is the priority. So only buy the highest quality companies that are cheap. Okay? So how do you know which are the highest quality companies? In the next part of this webinar, I will show you again my investment criteria, what I look for in a great company. That's coming up in a short while. But let me show you this very important piece of research. Ready? Listen to this. Since 1926 to now, 100% of all the wealth created in the stock market has only come from 3.44% of all the companies that are listed. Okay? In other words, about 97% of all the stocks listed in the market contributed little or no long-term wealth creation or even destroyed shareholder wealth in the long term. So what it's saying is that this, guys, in the long run, 97% of stocks will not make money. 97% of stocks will not make money in the long term. Only 3% of stocks will make money for you in the long term, okay? And even more mind-blowing, the top 1.8% of companies account for 90% of all the profits. And the top 0.26% generated half of all the wealth. So what does it tell you? It tells you that if you want to make money in the stock market, do you just buy any stock that you see on social media? Do you just buy any stock that is recommended to you? Do you just buy any stock that is going up in the short term? No. If you do that, you're going to lose all your money eventually. Yes, the share price can go up in the short term. In the short term, it can go up, yes, but long term, it's going to go back all the way down. Okay? So when I invest in a company, I want to make sure that not just the short term, but I want to make sure that 3, 5, 10, 20 years from now, the price will keep going up. Is that clear, everyone? So if I want to make sure that the stocks I buy will keep going up in the next 5, 10, 20, 30 years, I should only invest in the top what? In the top what? In the top 1% or less. The top 1% of the highest quality companies. Which are these companies? Later, I'm gonna show you. Okay, so hang on there. Are you guys still with me? Okay. Now, for those of you who say, Adam, I have got no idea how to pick stocks. I don't want to learn how to pick stocks. I'm too lazy. Can I still make money? Yes. So for those of you who are too lazy to take my courses, who are too lazy to follow what I'm buying, you can still be rich. How? Simply by buying the S&P 500 index ETF. That's it. Simple. This is the no-brainer way of investing in US stocks. So you buy an ETF that tracks the S&P 500, which are the biggest 500 companies in the US. Now, question, out of the 500 biggest companies, are they all great companies? Are they all great companies? No. So out of the 500 companies, you have got great companies, you've got good companies, you've got okay companies, and you've got crap, all mixed together in the 500. So the good news is that if you own all of them, the profit from the great company will make up for the losses of the crap companies. So that overall, it will still grow, okay? So what kind of returns should we expect from the S&P 500? What kind of returns should we expect? Well, if you look at the last 20 years, the S&P 500 gained 670%. That's an annualized growth of 10.75% a year. And this is despite all the ups and downs. So this is including the great financial crisis in 0809. And we had a crash in 2018, the first trade war, another crash in 2020, which was the COVID pandemic. Then 2022, another crash. So if you just stay invested through the ups and downs, your money is growing at close to 11% a year without using any brain, without picking any stock. And if you invest in the S&P 500, you will outperform 90% of professional fund managers. Okay? So that's the simplest way to invest. Now, in the last 10 years, the S&P 500 has gained 221%. Again, despite the crash, it's part of the game. It's like a roller coaster, but you stay invested through the ups and downs. You're getting 13% growth a year with dividends reinvested, and you outperform 90% of all professional fund managers. Because if you have watched my other webinars, I've shown you that less than 10% of professional fund managers can beat the index in the long term. Have you guys heard me say that many times before? Have you guys heard me say that many times before? Okay. So if you simply dollar cost average, that means every year you just put in a bit of money into the S&P 500, would you have a pretty good retirement account? Would you get a pretty good retirement account? Yeah. So you can see over here, if you earn 6,000 a month, assuming that's the average income of most developed countries, and you just save 10% of your monthly income, you invest into the S&P 500, you can see that in 25 years, you'll have 1 million. In 30 years, you have close to 2 million. without using any brain, without picking a single stock. Okay, and anyone can do this. Any moron can do this. Okay, now some of you may say, but Adam, I don't want to wait 25 years to hit 1 million. I don't want to wait 30 years to hit 1.9 million. I want to hit this target faster in 10 years or even less than 10 years. So is it possible? Is it possible to achieve this even faster in the next 10 years or less? Yes. How? How can we accelerate our wealth building? How do you accelerate this? By getting more than what? By getting more than 13% a year. By getting more than 10 to 13% a year, right? So if you can beat the market, then you can accelerate your wealth. So that is where I will teach you, or that's where I've been teaching people now for 20 years through my investment courses, how to beat the market. Okay. So how do you beat the market? How do you beat the market and achieve between 20 to 40% annual returns without having to stress and worry? Is the market going down tomorrow? Is it going up tomorrow? No, no stress. Okay. By picking the top 1% of great businesses in the market and buying them only at significant discounts. And the good news is now there are a lot of great companies selling at significant discounts. There are a lot now. You just have to know where to find them. And I'll show you a process in a while. Okay. Why is it important to pick the top 1% again? Let's take a look. This is the last 5 years. Now, in the last 5 years, if you bought the S&P 500, you would have gotten 93.9% without using any brains. Okay, again, any moron can do that. Okay, but if you bought the highest quality companies like Nvidia, up 1,200% in the last 5 years. Palantir up 758% in the last 5 years. Palo Alto up 280%. Alphabet up 235%. Booking up 133%. Meta up 119%. So when you buy the highest quality stocks, you will outperform the index anywhere from 1.5 times to 2 times to 8 times to even 13 times. To even 13 times. Right? Now, by the way, all these stocks I'm showing you are the stocks, as you guys know, are in my portfolio. Okay, so in full transparency, let me show you my portfolio. Now, I've got 3 portfolios. The first 2 are my capital gains portfolio, where my focus is on investing in companies that give growth. My third portfolio is my dividend portfolio, where I focus mainly on Singapore stocks for dividends. Now, my dividend portfolio, I'll talk about it during my webinar next week under dividend investing. But today, I'm going to talk about my growth portfolio. Okay. So my growth portfolio, I've got 2 accounts, which are actually both similar, right? So these are my 2 accounts. And my first account, right? You can see these are the stocks I've owned, right? Palo Alto, Broadcom, Mercado Libre, Booking, Nvidia, Microsoft, Alphabet, Meta, Amazon, United Health, ServiceNow. And right now, it has grown to 5.66 million US dollars. And my second account, this one, again, is similar stocks. Okay, Amazon, Nvidia, Alphabet, Meta, right? Palantir, United Health, Broadcom, Mercado Libre, Palo Alto, ServiceNow, Booking. This one has now grown to 5.87 million. So if you add it together, 5.66 plus 5.87, that's about 11.53 million US dollars, right? So if you convert to Singapore dollars, because I'm in Singapore, if you convert to Singapore dollars, that's 15.1 million Singapore dollars. Okay. Then my third portfolio, which is my dividend portfolio, which I'll show you in detail next week here, right? So I've got DBS Bank. Like I said, it's grown to over $1 million, my DBS position. I've got OCBC, UOB, CapitaLand Integrated Commercial Trust. I got Parkway Life REIT. So this is now um, yeah, 5.8 million. So 5.8 plus 15.1 is total 20.9 million. Okay. Now, like I said, last month it was actually 23 million. All right. It actually hit about 23.6 million. And then the last few weeks, the market's been coming down. So from 23.6 million, it's now 20.9 million. All right. So, like I said, your portfolio cannot go up every day, every week, every month. It doesn't go up in a straight line, right? You will go through ups, down, up, down, up, down, up, down. But over time, it will keep growing, right? So the fact that it's now dropped to 20.9 million, am I concerned? No, because I know by the end of the year, it'll be back to maybe 24, next year 28, it just keep growing. Now, the reason I'm showing this to you is not to impress you, it's not to show off to you, but to impress upon you that all the strategies that I teach, all the methods I'm showing you are the same methods that I use to manage my own portfolio, which is over 20 million, right? And I know to some of you it's no big deal. I've got students who have got 50, $100 million. They say, Adam, your 20 million is like nothing. I say, okay, that's fine, right? So it doesn't matter, right? But wherever you are, okay, you can grow your portfolio very consistently. Now, performance, let me, again, in full disclosure, let me share with you my performance this year and the last few years, because I don't think anyone else does this. So let me do that. Let me log into my account. Okay, so you can see that year to date, my portfolio is up 13%, right? It was up about 22% in October. Then last few days, the market came down, which is fine because it goes up and down, right? Later December, you go up again. No guarantees, but I think there's a good chance that from now to December, we should have a good bounce up. So it should get back up to, hopefully 15, 17, 18% by the end of the year. And versus the S&P 500, S&P is up 11% so far this year. So I'm above the S&P by 2%. And for the last 12 months, it's up 12.32%. Okay. But again, the year is not over yet. So let's see what happens by the end of the year. Hopefully, I can get close to 18% by the end of the year or 20%. Now, last year, you can see my first portfolio I showed you gained 24.8%. My second portfolio gained 22.4%. In terms of dollar gains, total was 1.7 million US in combined gains last year. Then 2023, my first portfolio gained 48%. My second portfolio gained 43%. In terms of dollar gains combined was over 2 million US dollars. So the point I'm showing you is this. Can you get 40% every year? Can you get 40% every year? No, it's not realistic. Okay. So I can tell you that there are certain years I get 40%, certain years I get 50%, certain years I get 20%, certain years I get 15%. All right. But on average, if you look at my long-term performance for the last 6 years, despite two market crashes, my portfolio grew 277% versus the S&P 500 that grew 171%, and that is an annualized compounded return of 21.74%. So this is my portfolio versus the S&P 500. I have outperformed the market consistently in the short term and the long term. And over the last 10 years, my portfolio is up 733% versus the S&P 500 up 280. Sorry, this is since, sorry, 10 years this year. My portfolio up 541% in the last 10 years versus the S&P up 193%, which I think is not bad lah. Not bad lah, huh? Not bad lah, huh? Now, is this luck or not? Do you think I'm just lucky for 10 years? Okay. By the way, the last 6 years, was it an easy market? The last 6 years, was it an easy market? It was one of the most challenging markets in the last 6 years. Most professional fund managers lost money in the last 6 years. Why? Because we had the COVID crash, we had the high inflation and high interest rate, we had the Ukraine war, we had the Middle East war, we had crazy Trump tariffs, we had all kinds of disasters, right? But I could still grow my portfolio 277% despite two bear markets and despite two wars and despite the economic uncertainty over the tariffs. What's my point? My point is this. I teach my students, as an investor, if you invest only in great companies, you have no fear of recession. You have no fear of market crash. You have got no fear of war. Why? Because if you own good companies, despite the market crash, despite the bear market, despite the war, your portfolio will keep growing higher and higher. Okay? So how many of you would like to invest in this way, where you have no fear of recession, no fear of market crash, that you invest in a stress-free way, in a worry-free way? Okay? Want to learn? Want to learn how to do this? Okay. So let's learn. Now, some of you would have learned this already. Great. Good review for you. If you have not learned this, it's your first time, please grab your pen and paper and write this down. This is the most important part of my lesson, which is the how I do it. Okay? So there are altogether 4 keys. There are altogether 4 keys to successful investing. And I like to use this acronym, WWHW. So what does the first W stand for? The first W is this. To be a successful investor, you must know exactly what to buy. You must know exactly what to buy. In the US market, there are over close to 5,000 companies you can buy. Or in the world, there's tens of thousands right now. Do you want to buy all the stocks? Do you want to buy all the stocks? No. Again, what did the research show you? 90% of all the, sorry, not 90%, 100% of all the profits came from what? 100% of all the profits in the long term came from how many percent? Came from only 3% of the stocks. Remember that? And 90% of all the profits come from less than 2% of the companies. So we only want to buy great businesses, the best of the best. We are not interested in buying average businesses. We're not interested in buying lousy businesses. We only want to buy great businesses. Now, you may ask, how do I know it's a great business? Okay, so later I'm going to show you, I've got a 7-step investment criteria for identifying great businesses. So for me, before I buy a stock of a business, it must pass my criteria. So I'm going to show you a lot of examples in a while. Okay. Now, so that's the first key. Number 2, once you know what to buy, you must know exactly when to buy. Why? Because listen carefully, a great business can be a lousy investment if you pay too high a price for the shares, if you buy it at the wrong time. But a great business can be a great investment if you can buy it for less than what it is worth. Okay, I repeat, a great business is a great investment if you can buy it for less than what it is worth. So in other words, we only want to buy great businesses when they are undervalued, when the share price is selling below the intrinsic value of the business. Now you may ask, how do I know what's the intrinsic value? How do I know what it's worth? Okay, coming, right? I'll come to that in a while. Now, this is no different from real estate. Let me ask you this question. Let's imagine that you want to buy an apartment and you found a beautiful apartment, great view, great location, beautiful furnishings, right? What do? You get a bank valuation. Now, the bank values the apartment at, say, $2 million. But the seller is asking for 2.5 million. And you got so excited by it because there's only one left. And you say, okay, I pay 2.5 million. Now, is that a good investment? No. Right? Because you paid $500,000 overvaluation and it'll take you longer to eventually break even if you sell it. It's like people who bought Sentosa Cove in Singapore. After 20 years, they still lose money. Have you read about that? Because they overpay ridiculous price. Ridiculous price, right? But if, let's say the seller of the apartment was desperate. Let's say he's going through a divorce. His business went bankrupt and he has to quickly sell the apartment. And at that time, no one was there to buy. You're the only one there. And you said, okay, I tell you what, I buy your apartment for 1.5 million. And he says, he's desperate. He sells it to you. Now, is that a good deal? Yes, you bought it $500,000 below valuation, right? Okay. Question, is it easy to find those deals in the real estate market? Is it easy to find a desperate seller? No, it is very difficult. Very difficult, right? But you know what's the good news? The good news is that it is very easy in the stock market. Because in the stock market, there are times every year when investors panic because of all kinds of reasons, right? And when they panic, they are willing to throw their stock at 20, 30, 40, 50% discount. And if you know which are the great companies, the great apartments with the great view and the great location, and you can buy 20, 30% below valuation, you make a lot of money. Is that clear, everyone? Is that clear? So how have I made millions in the market? I make millions in the market by buying great companies when sellers are desperate. When people are panicking, they're desperate. Ah, we're gonna die! Oh, we're gonna die! And they sell their good company at 20, 30, 40% discount because they thought it's the end of the world. That's how I managed to buy Meta that time at 70% discount. I bought Google at 40% discount last year. I know many of you did at the same time, right? Because people thought, oh, ChatGPT is going to kill Google. Google's going to be broken up, or Google's going to die. Freaking idiots, right? If you analyze the business, you know that they're making more sales and profits every year. Their moat is getting stronger. So ignore the analysts, ignore the news, trust the numbers, trust the research, and take advantage of people's short-term panic and short-term mentality. Is that clear? Okay, so a lot on psychology that you're going to learn in the course. All right, next. The third key, once you know what to buy, you know when to buy. Number 3, you must know how many shares to buy. Very important. Okay, listen very carefully. No matter how great you think a stock is, do you put all your money in one stock? Do you ever put all your money in one business? No. Why? Because no matter how great a business is, shit can happen. Shit can happen that you can't always foresee. So always divide your capital into minimum what? Always divide your capital into minimum at least 8 to 10 great companies, right? At least 8 to 10 great companies, so that if one or two of them shit happens and the share price drops in the short term, it doesn't matter, right? Because the rest of the companies will go up and bring up your portfolio, right? So as you guys know, I bought Alibaba back in 2016. Or was it 2017? Yeah, I've been holding Alibaba now for yeah, like 9 years, right? So I bought Alibaba and I had no way to predict that Jack Ma would piss off Xi Jinping, right? And they cracked down on the tech companies and my Alibaba dropped 60% in 2021. Could I predict it? There's no way I could predict it, right? But did it matter? It didn't matter because in 2021, my portfolio still grew close to 30% because my Alibaba went down, but my other companies went up, right? And by the way, today I'm still holding my Alibaba. I've not sold it yet, right? Because there's the company, there's nothing wrong. It's still growing. It's still okay, right? Okay. So this is called portfolio allocation and diversification, where we'll go into in detail in the whale investor course, and you will see exactly how I do it every day in the Ultimate Investors Playbook subscription. Okay. Finally, you must know when to sell. A lot of people, you know what's their problem? They say, Adam, I know what to buy. I know when to buy. I don't know when to sell. I don't know when to sell. You gotta know when to sell. Some people, you know what's their problem? They sell too early. Okay? They buy a stock, it goes up 20%, 30%, 50%. They take profit. And then the stock goes up 1000%. They're not there. It's like when I bought Nvidia at $15 in late 2022. Many people also bought Nvidia. I bought Palantir at $9. Many people also did that. I shared it in my YouTube videos, right? But when Nvidia from $15, it went to $30, people said, oh, it already doubled. It already went so high, it can't go higher. They sold all at $30, right? Now Nvidia went up to 200. Now it dropped to 180, but it's still up more than 10 times. Have I sold any Nvidia? No, because Nvidia is the most important company in the AI revolution. Because to build robots, to build robo-taxis, agentic AI, everything needs Nvidia. There's only one Nvidia. AMD is very far behind. Intel is very far behind. And that's why, even though my Nvidia grew 1000%, I ain't selling shit. I ain't selling a single share because I'm holding for the next 10, 20 years. There's a long runway. Same thing with Palantir. Now, I've sold quite a lot of Palantir because at the time when I sold it, it was way overpriced. But recently, Palantir's profits have caught up, so it is not that crazy expensive anymore. It's still not cheap. Palantir's still not cheap, but at least not super crazy expensive. So I'm not selling any more Palantir. In fact, I'm hoping it can drop a bit more. If Palantir can drop below 140, 130, I'm going to buy more Palantir, right? Because again, Palantir is the only pure play AI enterprise software company in the world. And there's no close competition, all right? So don't sell too early. If not, you will make peanuts. We call it kacang putih money in Asia. You will not make millions. You cannot sell too early. But at the same time, once it's way overpriced, once the company has a risk of being disrupted, you got to get out. Okay. Like Adobe. I used to own Adobe and I sold all my Adobe at a small profit. Okay. Because I think Adobe, if you watch the latest Nano Banana Pro from Google, you look at that, you will be very scared of owning Adobe. Because why would you need Adobe anymore when the latest AI Nano Banana can create everything you want in seconds? Okay, so the moment I feel that there's a chance that the company's business model, the mode could be disrupted, I'm out. Same thing with Duolingo, right? I bought Duolingo for a short profit. I made double my risk and I got out, right? So you have to know when to get out. Okay, so far is it useful, everyone? Does this make sense? Okay, so let me go into greater detail, okay, on what to buy. So again, I only buy great businesses that pass my criteria. I've got 7 criterias for a great business. And less than 1% of companies pass my criteria. less than 1%. So we only want to invest in the top 1%. So what are my criteria? Let me run through for those of you who are new to this. Write this down. Number one, I only invest in businesses that have a track record, have a history of consistently increasing sales revenue, net income, and cash flow from operations. Okay? For at least 5 to 10 years. Please write this down. At least 5 to 10 years. So in other words, I want to make sure that the last 5 to 10 years, the business revenue is growing year after year, after year, after year. The profits are growing consistently, and the cash flow from operations is growing consistently. Why? Why is that important? Because if a business can grow their revenue, profits, and cash flow for at least 5 to 10 years, that means the business is predictable. Please write this down, everyone. Write this down. We want the business to be predictable. Number two, it must be consistent. It must be consistent. Number three, it must be resilient, which means that even in a recession, even in a pandemic, the business must be able to still grow their revenue and their profits. Now, can all businesses do this? Can all businesses pass the first criteria? No. In fact, I can tell you that less than 5% of businesses can pass my first criteria. So if you just apply my first criteria, it would eliminate 95% of all the companies. So let's look at a few examples, shall we? Now, I'm from Singapore. So people always like to ask me, what do you think about Singapore Airlines, SIA? Now, let me just say that I love Singapore Airlines as a customer. In fact, when I fly, I only fly on SIA, only SIA, because best customer service, best safety record. But will I ever buy shares of Singapore Airlines? Will I ever buy shares of SIA? No, never. Why? Because all airline businesses are not great businesses. It's not the fault of the management. It's the nature of the whole industry. Okay? Because they all fail the first criteria. They can't pass the first criteria. No airline can pass the first criteria. So let's take a look, shall we? Okay. So let's look at Singapore Airlines here. Now, by the way, this Singapore Airlines I'm looking at, oops, I just got logged out. Hold on. Let's log back in. Okay. So right now, as you know, Stock Oracle only shows US listed stocks. Okay. Next year, we'll be rolling out Singapore, Hong Kong, and China stocks on Stock Oracle next year, but now only US listed. So I'm going to show you Singapore Airlines, the one listed in the US market. So this is in US dollars. Okay. It's the Singapore Airlines shares listed in the US market. So if you take a look at Singapore Airlines, let's look at the financials. First thing you always do, look at the 5 to 10 year track record. Okay. So we can look at bar chart if you want. Okay, let's look at the bar chart. Now, you can see the revenue. Okay. Is the revenue growing consistently? Does it grow consistently in the long run? Well, it's not too bad. It's not too bad because you can see that, yeah, it's a bit cyclical. Now, of course, this was the COVID pandemic, but it's going up. So overall revenue does go up. So revenue is not bad. It's not bad. Okay. It does generally go up in the long term. But the problem is what? The problem is the what? Is the what? What's the problem? What's the problem? The problem is the net income is not consistent. Okay. So if you look at the net income, which is in green, what do you notice? You see the sales are so high, the profit is so low. Can you see the profit so low? And then here the profit dropped by half. Then the profit went up. Then the profit dropped by half. Then here lose money. Here lose a lot of money. Then here lose money. Then here make money. make more money, make the same money, and then here drop again. Can you see? So it is not consistent. So make more money, make less money, make more money, make less money. It is not consistent. Do you follow what I'm saying? The profit doesn't grow consistently. It is up and down, up and down. It is very, very inconsistent. And look at the free cash flow. Look at the free cash flow in green. Look at it. Negative, 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 negative. Very positive. Drop by half. Drop again. Drop again. Look at it. The free cash flow is going down. Okay? Now, what does it mean? That means, now, what's the problem with the airline business? Why is the airline business having negative free cash flow? A lot. Why is the cash flow not positive? Why is the profit so inconsistent? Why? What's the problem with the airline industry? Number one, is very competitive. There's too much competition and there's very high costs. There's high labor costs, high maintenance costs, high fuel costs, right? Now remember, what is a business? A business is a money-making machine. So if the business cannot make more money over time, it cannot be worth more over time. That's why the share price cannot go up over time. So if you look at the share price of Singapore Airlines, let's put it in the share price here. This is the US listed one. What do you notice in the long term? This is the last 10 years. What happened? If you hold Singapore Airlines for the long term, what happened? Right? You can see 10 years ago, it was selling at $8. This is in US dollars. Huh? In US dollars. You can convert to Sing, right? After 10 years of holding, is now at $4.90. Hold for 10 years and it's still down. Look at that. It's not the fault of the management. It's not their fault. It is all airlines are like that. It's all the same. Okay? So I avoid these kind of companies because it's very hard to make money. You understand? Now, on the other hand, what companies do I like? I like companies that have very low physical capital expenditure, all right, that are very scalable. So example, let's look at MasterCard. Now, let's look at the difference of MasterCard. Let's look at financials here. Can you see this chart, everyone? Look at the revenue. Is the revenue growing consistently? Yes or no? Even in the pandemic, even in the greatest pandemic, their revenue only dropped a little bit. We call this resilient, recession-proof, pandemic-proof. That is what I want. and look at the net profit. Is the net profit very consistent? Is it growing consistently? Yes or no? Yes. So if the profit is growing consistently, you can easily project it to the future. If it's inconsistent, you can't do any reliable projections. And the profit margin is very high. The profit margin is like 30% profit margin. Whereas Singapore Airlines, the profit margin is only, I don't know, 5% or profit margin, right? And look at the free cash flow. The most important thing is the free cash flow. Look at the free cash flow. Is it growing consistently? Is it generating more and more cash every year? Yes, this is the kind of business that I find very, very, very predictable, very consistent, very resilient. So if you look at MasterCard, does the share price look like that? Does the share price look like that? No. If you put in